Let's bring in Michael Nathanson, SVB MoffettNathanson founding partner, has an outperform rating on Disney, although he did take his price target down by $5 to $115. Michael, you were an active participant on the company's conference call. You got one of your questions answered, the other one you didn't. But give me your overall take on the quarter and what you heard on the call from Iger.
Okay, so David, the quarter was not as bad as we feared. We talked about that right after Bob spoke with you in Sun Valley. A bit better than we thought. Cost savings definitely helped. And we're still waiting. We're all waiting for the payoff of what Bob's vision will be and what he'll do upon maybe potentially the separation of this company. So it's a journey. We dodged what we thought was going to be a tough quarter. And I think we're all looking forward to seeing what happens in 24 when they buy in Hulu and what changes he's going to be able to affect in terms of capital structure.
Yeah, I wonder, though, from an investment perspective, sort of what energizes this stock price? Obviously, it'll be when they have a great quarter. But is it, if they do this deal in terms of selling stakes in ESPN to a league and or a technology partner of some kind, is it, again, I ask you the question, what in your mind is going to sort of be that point at which suddenly people look at Disney differently as they are not looking at it particularly well right now?
Okay, so it's funny. I got an email from a client today. I'm going to echo what he said. We've always thought that Disney worked when the earnings were beating streets. And that when Bob first got there, he was just crushing street numbers. The past 3 or 4 years, it's been the opposite. They need to get numbers to a place where they can start beating consistently, either through cost cutting or some top line surprises. But there's so much uncertainty on forward estimates that I think that's our fundamental issue is like, look, until we on the street can better model the company and the company has, abilities to beat estimates, I think we're going to be in this range. And that, to me, is what Bob was able to accomplish in the beginning of his career. And the past couple of years, either with Chapek and Bob Iger, they've been missing street numbers and numbers have been coming down. So I think that's the answer, David. We need to get confidence in their ability to hit forward estimates. And that's going to take some time.
Yeah, well, listen, they have taken a good amount of costs out of direct to consumer, but you guys have done a lot of work on streaming at MoffettNathanson. So give me your take on this strategy to raise prices significantly on the non-ad tier. Does it send people to the ad tier? Does it actually promote more churn? How does that figure out in your opinion?
Okay, if Disney Plus was a normal streaming product, I'd be very worried about those price increases. Vegas raised prices $3 a year ago, and they gave people the chance to spin down to the ad product. And it seems like no one spun down, right? So our view of Disney Plus is it's a super fan service for fans of Marvel and for families, right? It's not trying to play the game that Netflix is in or Amazon or HBO Max. I think it's a smaller service with higher pricing. That's been my thesis all along. Disney's parks have great pricing. So I think Disney needs to, reorient its strategy. I remember talking about this when they launched this product. They launched at such a low price point that they added a lot of subs that are not, they're losing $2.5 billion a year at Disney Plus with $8 billion of revenue. It's not a good model, right? So something has to change. And to me, raise prices, lose subs, that's fine. The business has to become profitable.
All right. Again, we'll be keeping a close eye on it, always with your help, Michael. Thank you.